Hey everyone, welcome in to another daily editorial here on the KE Report. I'm chatting with Joel Elconin. We're going to be talking about the markets, going to be talking about Nvidia, the bit of a pullback coming from that stock that was just recently, I'm sure you all read the headlines, it was worth more than Microsoft. Also dive into some of the individual sectors within the markets, see what Joel's seeing in terms of strength or weakness. Joel is the co-host of the Benzinga Pre-Market Prep Show, also editor of the Pre-Market Prep website. Joel, let's start off with Nvidia. Look, it was all the headlines that Nvidia was worth more than Microsoft, over $3 trillion. Their earnings seem to back it up. Look, they're in a growth sector, right? And they're one of the leaders there, but it's hard not to look at a chart that has just exploded like that and say, ooh, man, this could be bad if it turns to the downside. What's your thought on Nvidia?
Good afternoon and happy quad witch expiration. Something only happens 4 times a year. I mean, come on. It had a pre-split run. A lot of times stocks are anticipated to go down after a split. That lasted about 15 minutes on the split day. It just tacked up. It finally hit the only thing you could call it is a psychological level. Got over 140. I actually traded over 141 in the pre-market, I believe, 2 days ago. And then it got sellers. People buying the upside options, buying the calls, the 135, 140 calls. They finally got stuffed. And the people that owned, stock lower took the opportunity to perhaps put some hedges on and started selling the calls. And when something has that kind of a move to the upside, I mean, there's always going to be corrections. Now, how deep and how severe will the correction be? Well, we'll just have to ride it out. But down again today, getting some follow through. But I mean, come on, look, the stock has doubled in just a matter of time. So we'll see. I can't really give you. I mean, we're so far off the all-time closing high. Well, not so far off. What I was talking and what I'd be doing if you're an Nvidia shareholder is just keep an eye on those marks, right? Where people are marked. People that were trying to buy the dip yesterday, the mark, right, was 130.78. Well, during that little rally that you had this morning, it got within 14 cents of that, 130.63. Now you're back under 127. So the all-time closing high, 135.58. That's a little bit of ways away, but if you get a rebound rally, I would keep an eye on that as opposed to that all-time high. Yeah, it was yesterday at 140.76. As far as support goes, man, oh man, right now, people are like, oh, 120. If this thing ever gets to 120, I'm loading the boat. I can't see that 120 area right now. I think I always look for just a series of lows in one area. I have one daily low at 122.57, and then I think you got to look more to the 118 area. For me, that's what I'm looking at as support in Nvidia.
Okay, thanks for sharing that there, Joel. Now, more of a bigger picture concept is that we have seen a lot of capital become concentrated in the tech sector again. And I think it was last year that narrative was shifting to that being a defensive trade because these companies have so much cash. It seemed like that was the new safety play of moving into tech stocks. What's your thought on that whole narrative? Is tech the defensive play now?
Tech wins, right? No matter what. I mean, high rates, low rates. Yeah, it is. And what you mentioned, the breadth, and it's just, you talk about the concentration of stocks. I mean, it's never a great sign. You want to see more of a broad-based rally, but on the other hand, that the market's not looking at it that way. It's chasing, money chasing other money, and that's what happens. It's a pure momentum market. I don't know if I call it the safety trade, but it seems to survive in a rising interest rate environment, and it seems to survive in a declining rate environment. So it's defensive, but I would call it, I would be cautiously defensive is how I would put it.
Joel, how are you seeing the balance between strong sectors, again, mostly being tech, maybe some other defensive names that have started to pick up, and sectors that have remained weak, even the small caps that just can't seem to get out of that range?
Yeah, I mean, just going to the small caps here. I mean, come on. They get the news what they wanted, and inflation coming down, hope for the Fed cutting before the election, and it just got pounded. The news that you wanted for as a gateway to investing in going to the small cap market, taken absolutely the opposite way. So one thing I've learned over the years being in the markets is when you're looking for a catalyst and you supposedly get that catalyst, and then a good catalyst and the market reacts negatively to it, that's like a double whammy. So they sold the daylights out of that thing. There's just no interest in that, even with the aura of the rates coming. So it's just really astonishing that what's happened to the IWM, and I'll just leave it at that. I mean, it just feels like it's never going to break out. It feels like it's never going to be in favor again.
Well, that's right where the chart is too, though, right? Is that you look in 2021, it was trading in a higher range. And then 2022, 2023, it was in a lower range. And now this 2024 range, it's kind of right in the middle. So it's not like it's overly bearish, but it's not bullish, though, is it?
No, I mean, I see what you're looking at. You're so off the 2021 high. You're substantially off the 22 low, which you revisited just at the end of 23. So I guess from a constructive standpoint, you're consolidating. And I'm just looking at the consolidation that it had in 2021 before it busted out the all-time highs, but it came back into that consolidation, kind of faked people out. And if so, you're looking like for a year that thing traded in a range. Let's just blow out that all-time high over 240. I mean, it traded basically between what 210 and 230 for almost a year. And now we're coming into a consolidation period. It's really pretty much been the whole year. So maybe be patient. Maybe another 6 months of this might resolve something. But when things are in a range and in a consolidation range, and you have to trade that way, and you have to adjust your parameters. But you're right. Man, it can't hold the 210. And then on the other hand, you're saying, well, we made a higher low in May and we made a higher low in June. So it's tough. And the best thing I can say, it is consolidating towards the upper end. I guess upper end of the trading range if you look at the action in 2024.
Yeah, fair enough. You can try to be bullish on it, but it is hard. But it's also, in a way, kind of hard to be bearish because it's not breaking down. So that is the small caps, and that's kind of been the story of the small caps over the last few years. Joel, just a quick touch on the VIX. We don't talk about the VIX too much, but some people have said that the VIX has been pretty depressed, and it has been in terms of the last couple of years. But we go back, I think it was about 10 years ago now. Man, oh man, the VIX didn't move for over a year. It was almost in single digits. Right now, sitting just above 13. How much attention do you pay to the VIX to just judge investors' either bullishness or tentativeness for investing?
I tend to focus more on the average daily ranges and look for and it's a component of the VIX too, of the expansion or contraction of the average daily ranges. And right now, we're at like 50 to 60 handles, which is pretty get up during COVID. Yeah, your average daily range could be 100, 150 handles. And then, like you remember, not too many years ago, jotting down the average daily range in the S&Ps was like less than 20. So you just want to, I would keep on, I mean, it's good that it's low, but when you get a shake-up day and you get the expanded range, let's say you get an expanded range to the downside, then you got to take note. You got to take note whether things are going to just hold steady and find a bid, make a couple lows in the same area, or you're going to get expanded. We've had a period of low volatility, and with the rotation that goes on in the market, like I just said, speaking of this today, I mean, there's even rotation within the rotation of the sectors. So If they're selling something, they're buying something else. So that kind of keeps the market muted, and you don't just get these all out rip or down days because money is always looking for a home.
Now, that is the question. Would money rotate out of the markets or even more so into something like the bond market? We haven't seen bonds do a whole lot recently. They've, in a way, kind of flatlined for most of this year. Where would money rotate to if it was out of the market?
Well, I mean, you could go to bonds and the anticipated lowering of interest rates. It's supposed to be good for the bond market, but I just look at it is that rates were artificially low, right? And they were probably on the course to start raising rates, and then COVID hit. They had to turn on the spigots and flood things with liquidity. So I just don't see the bond investment. I see rates being steady. So if you have steady rates and you don't want to be in the market and inflation's coming down, it's boring as hell, but cash is cash, right? And if money's going to come out of the market, we'll find temporary homes. I mean, temporary places to go, but right now, it's hard. If you want to be out of the market, it's hard to turn down 5-6%.
Now, does the summer season play into that? Do you see more people saying, you know what, I'm going to take a little break, put my money in something safe, at least make a little bit on that, and come back maybe in a couple months and see what I can do with it?
Now, market just goes up, Corey. You
Well,
just
that's
know
the
that.
thing, right? They keep it in the market.
Yeah. Of course, some periods of profit taking or re-asset allocation, but right now, based on the factors of what we're seeing, I don't see a big exodus out of the market. I don't see is China going to invade Taiwan? Well, that hasn't happened yet. Was Russia going to expand the war in Ukraine? Well, they've already done that. How are things in Israel? Well, they're not getting any better, right? So right now, I mean, you can look at the market and say, yep, this is time to cash out. And I've talked to some very respected analysts that are just like, the markets are so far above their targets for the year, they don't even know what to do. They don't even know what to do as far as pulling money out of the market and putting it other places. So that's my take on that.
Fair enough, Joel. Now, what about the overall concept here of, look, markets are continuing to move higher, but we're also just almost prone to economic data simply because everyone's guessing what the Fed's going to do. And quite frankly, the Fed hasn't done anything for quite a while. Which economic data do you pay attention to? Or on the flip side, does it even matter right now until we get some clarity from the Fed or an actual rate cut?
You know what? Based on the market's reaction to the inflation numbers right now, I just don't think it's a factor. I don't think rates are as big a factor. One economic night, I will just go to the technicals on that, and I'll reevaluate things after the quarter. But right now, just concentrating. My main focus would be the old-time closing high in the S&Ps. That was made a few days ago. Let me get the exact number. So, yeah, I mean, do you notice just the way it ebbs and flows with unemployment's so important. And then we came out with those horrendous unemployment numbers during COVID, and the market went up. And now the focus is inflation numbers. The inflation numbers were good. The market did respond off that. But my focus right now is at close on Tuesday. That was 55, 59, 75, or 20 handles away from that. So that's what I'd be looking for to see the next direction in the market. And I think investors should do that with their portfolios as well.
All right. Hey, Joe, thanks for taking some time talking about these markets. It does feel like it's slowed a little bit, but that being said, still that upward bias to these markets is, I think it's 8 out of the last 9 weeks that the S&P has been up, and some other sectors that have been doing quite well, they're also moving sideways, potentially just consolidating some of those gains, waiting for that next move higher. And again, whether it's economic data, Fed comments, or just traders getting more aggressive and more active, who knows what's going to drive it. But overall, still uptrends in a number of areas. Joel, thank you as always for your time. It's great chatting with you, buddy. I hope you have a great weekend.
Okay, we'll talk to you next